questions, lots of concerns, and I guess we're going to have to start with 3 letters, SVB.
Right, Silicon Valley Bank. Essentially, they're out of business. They were forced to close by the FDIC. The bank will probably be sold over the weekend. And the thing about that bank that's kind of interesting is they were a source of financing for any number of venture capital firms in Silicon Valley and the rest. And essentially what happened is an old-fashioned run on the bank.
Right. And you remember, of course, that in 08 and 09, that happened a lot. Remember back in those days, we'd come in on Saturday mornings to do radio shows, and we'd have to announce the bank failures, and that went on for a long time, Danny. But this concern is a little different. Their balance sheet is much different than the big banks on how they're financed.
Right, and they aren't subject to the same level of stress tests that the J.P. Morgans and Wells Fargos of the world are. So essentially what happened is they had bought a bunch of bonds, and as depositors were moving money out of the firm, whether it's to buy treasury bills or to finance their own offerings, they basically had a capital squeeze. So what they had to do is sell bonds at a loss. They had to write that down. In addition, they issued equity to basically raise more capital. But at the same time, on Twitter and everywhere else, people were saying, pull your money. And that got to the point where they basically couldn't meet all of those requests. And the FDIC stepped in on Friday afternoon.
Yeah, and they shut the bank down. And over the weekend, as you said, there probably is going to be some type of more movement. And of course, when you hear that, you go, what happens to my money if you were a customer? Well, they're going to, on Monday morning, we're going to get some more information. But very likely, the way this works is the FDIC comes in and then honors all of those deposits, as this has happened before. So it's not anything that is new, but it's something that we don't want to make into a domino effect because of what the Fed is doing. And as you know, Derek, I have been pounding on the Federal Reserve for a long time that they're going to keep raising rates until they break something. And boy, oh boy, this might be right at the cliff.
Yeah, and it's kind of ironic. It's right in front of another CPI and PPI report early next week, and then the FOMC meeting on the 21st and 22nd of March. And what you were saying that implicitly in that is, in the Fed's effort to quell inflation, they're starting to create credit risk in the economy, and that's something that is more problematic in many ways than whether the inflation rate is 4.2 or 4.1%.
And man, let me
just amplify itself.
Okay, and let me just jump in and ask you this question. Of course, the Federal Reserve, one of their jobs is this mandate that we talk about, but they also supervise the banks, so they're in this on both sides.
I certainly believe that they're aware of the situation there, the vulnerability that bank had to, kind of a drying up of capital in Silicon Valley. We saw very little M&A, new IPO activity last year. So some of these growing startup companies have been thirsting for capital, and they were a lender at those levels. The other thing that we need to talk about, too, is, we did have that jobs report on Friday, and it was a little better than expected at 311,000, but the unemployment rate did rise from 3.4% to 3.6%, and we have seen a slight uptick in jobless claims. So the impact of these Fed measures is starting to have a little bit of an impact on the labor market.
And the big story then, of course, was we have this tool that we look at what we think the Fed is going to do. It's a Fed watch tool. And earlier in the week, it was 75% chance that they were going to raise that by 50 basis points at the next meeting. That precipitously dropped later in the week.
Right, down to 30%. And the other point that we keep making is, the 2-year note is now yielding 4.61%. So if the Fed does raise that rate by 25 basis points, just as an example, that will be north of where the 2-year is. And historically, that is about the time that the Fed begins to think about pausing because, again, we know monetary policy acts with a lag, rate increases act with a lag, and reduction of the balance sheet reduces liquidity, which is something that we saw negatively impact Silicon Valley Bank shares.